this question here. Given a risk-free rate of 4%, a market return of 11%, and a stock with a beta of 1.25, calculate the required rate of return for this stock using yes. Is there a question?
Yes, sir. I wanted to ask on the comment on the previous answer. There was a comment. The question asked like you comment on the diversification benefit.
Oh yeah, they're not here, sir. You read them, okay? Right now, I don't have any comments right now on that one.
Oh, okay.
Okay, so colleagues, the capital asset pricing model, in simple words or in simple terms, it just shows us the relationship between the return of a stock and its a risk. And it tells us in order to get higher returns, you need to incur higher risks. In order to get higher return, you need to incur a higher risk. So let me explain each of the components of this capital asset pricing model, CAPM. The risk-free rate. Okay, this is the interest rate on government securities. Colleagues, why do you think government securities are risk-free? Well, they work with the central bank who prints the money. Government can never be broke. Okay, so they will eventually pay you. Okay, that's why it's risk-free. Government will eventually pay you. Okay? They are the ones who work with the central bank and who print money, so they can just tell the central bank print money and pay this person in. Okay? So government securities, okay, they are risk-free. That's why the returns on them are low. Okay, because they're not encountering any risk if you invest in government. Okay, but theoretically, that's theoretically. In real terms, the Zambian government has been known to default on some payments. Okay, on investors in treasury bills and treasury bonds. Okay. But theoretically, the government can't fail to pay you. Okay, so the risk-free rate is the interest rate on government securities. Remember that. The market return. This is the average return you get if you invest in any stock market. So if we say the Lusaka Securities Exchange has got a market return of 11%, what it's just saying is that if you invest in any company within the Lusaka Securities Exchange, expect a return at least of 11%. It might not be 11, but on average, expect a return of 11%. This beta, equity beta, it measures risk of stocks, okay, in relation to the stock market. All right. So the benchmark is always 1 for equity beta because the market return is situated at 1. So if you have a beta of greater than 1, like this one, 1.25, it is showing you that this stock is a risky stock. It's more volatile than the market. Okay, if the market index increases, the stock price will increase at a higher rate than the market. Okay? If the market index reduces, this stock is going to reduce more than the market. Okay? A market index, colleagues, an index is just one number that represents a lot of things. When we say a market index, it's just like a collection of various companies being represented in one market. Okay, you've heard of the Nasdaq, the Dow Jones. So if that market index goes up and your stock has an equity beta of greater than 1, it means even the price of your stock will grow at a higher rate than the market index. Okay, which is a good thing. But if the market index goes down, then your stock is going to drop. Price of your stock is going to drop further more than the market index. Right? So that's what the equity beta is. It's just the volatility of a stock in relation to the stock market. If you have an equity beta of less than 1, okay, then your stock is not as volatile as the market. Meaning if the market increases, the stock price might increase by a small amount, okay, but not greater than this market index. The market index drops, your stock price won't drop by a big amount. It will drop less than the market index. Okay. So this equity beta, okay, what you notice in the capital asset pricing model formula is if you increase this equity beta, you'll notice that your returns are also going to increase. So here's the formula for the capital asset pricing model. Okay. Risk-free rate, RF, 4%. Beta, 1.25. Return on the market, 11%. Again, risk-free, 4%. Now, one thing I need to mention is this return on the market minus the risk-free rate is also called equity premium. What equity premium is just the extra return you get for investing in riskier securities. Okay, the extra return that you get when you invest in riskier securities. As we said earlier on, for you to get higher returns, you have to incur more risk. So someone who's going to invest in a government security shouldn't get an equal return as someone who's going to invest in a company. Because the one who was invested in a government security, that's risk-free. You eventually get paid. Now the one who has invested in the company can close down. They might not get paid. The company will make losses. They might not get paid. So for you who's going to invest in that company, where there are those risks involved, you have to get an extra return, which is very fair, right, colleagues? Because yeah, the more you put in, the more money you expect to get also. Okay. Colleagues, just hold on. I just want to connect this thing here. Just hold on. Yes, so you do 11 minus 4, 7%. 7 times 1.25, 8.75%. 8.75 plus 4, 12.75. Okay. So this is the return an investor should expect for investing in this stock. Any questions? Okay, let's see if we increase the equity beta. Let's see what happens. So 11 minus 4, that is 7. 7 times 2, that is 14. 14 plus 4, we get 18%. Okay? The return has increased. So each time you increase this return, this risk, which is the equity beta, the returns are going to be increasing. If you reduce, let's say for example, if reduce from 1.25 to 0.8, 0.8 times 7, that's 5.6. 5.6 plus 4, that is 9.4. You get a lower return, 9.4%. So that's what this capital asset pricing model is illustrating, colleagues. Want more returns, you need to incur more risk. As you can see, if you incur less risk, like 0.8, you get a lower return. Okay. If you incur more risk, let's say you increase the beta to 2, the return increases. If you incur zero risk, like government security, here you put 0, means you just get this 4%. Okay, so that's how you deal with capital asset pricing model. It just shows us how to get high returns, you need to incur more risk. Any questions? So the next part, your explanation of beta using the Osaka Securities Exchange. So the market in the red line, the one with the green line, will say it has a beta of 1.25. This one we're going to say has the one in the blue line, let's say has a beta of 0.5. So as we said, beta is measuring the risk of a stock in relation to the stock market. Okay, so the stock market has a beta of 1. In this case, we had a beta of 1.25. Okay, so basically what it means is if the Osaka index goes up by 1%, so imagine this, the Osaka index in the red line has gone up by 1%. This beta is going to the price of these shares is going to go up by 1.25%. Okay, greater than the stock market. Okay, which is a benefit for someone who has invested in this share. If let's say you had a lower beta of 0.8, it means the Osaka index goes up by 1%, yours is just going to go up by 0.8%, which is lower than the stock market. Okay, a beta of 0.8. Which is a good thing. Okay, if your stock has got a higher beta, it means if the Lusaka index, Lusaka Securities Exchange index goes up, it means expect share prices of your stock to grow higher than the Lusaka Securities Exchange index. Okay, meaning you can now make profits if you sell those shares. Okay, now on the downside, okay, if the Lusaka index falls by 1%, it drops by 1%. Let's see whether can I make another graph. It has dropped by 1%. You was got a beta of 1.25. Your share price is going to drop by 1.25%. It's going to fall more than the Lusaka Luse index. Okay, share price is going to drop more than the stock index. And then the person who has got a beta of 0.8, them at least their stock price will just drop by 0.8, which is less than the stock market. So you'll be safe. Okay, so beta is just showing the relationship of the stock's volatility with the stock market. Okay, a higher beta, it means your prices will grow higher than the stock index, and when it's dropping, it will drop lower than the stock index. A lower beta, it means when the stock index goes up, your price will go up by but lower than the stock index. The price will go up but lower than the stock index. And if the stock index goes down, your price will drop lower than the stock index. Yes, any questions?